Welcome, board members. Mr. Singh has invited us, WGL consultants, today to share recommendations for the mix of debt and equity at Deluxe Corporation. We're excited to be here at the largest paper check printer in the U.S. Your industry and your company has taken many steps to improve financial performance, like retiring long-term debt, repurchasing stock, restructuring to reduce overhead, and divesting non-core businesses. Investors have reacted favorably, as seen by the increase in stock price, but these steps can only take you so far, and your decision to adopt a pure play strategy focusing solely on the core business segment of check printing can have many risks. This business segment is operating in a challenging environment that is very concentrated and heavily competitive. Check printing is a mature industry, and by focusing on this business, there are risks of not having enough diversification and risks of having limited growth opportunities. Growth is challenging due to changes in technology, which can increase customer preferences for alternative payment sources and decrease the demand for printed checks. So to support this business strategy, Deluxe will have several financing needs, including general corporate purposes. This is like capital expenditures, dividend payments, meeting debt service payments, and increasing your increasing working capital needs under tighter asset management practices. In general, financing is needed to support ongoing operations and to help provide a rainy day fund for operating in this competitive environment. Before we discuss recommendations, we considered these financing needs and tried to balance several competing priorities. This includes value creation or minimizing the cost of capital to maximize shareholder value, getting an optimal bond rating to lower financial costs, but also avoiding reputational costs of being associated with a junk bond rating, having flexibility and adequate reserves for a worst case scenario, and we considered the feasibility of implementing financial policies under current and future market conditions.
Thanks, Nancy. So if we look at this slide, we can see the analysis of the flexibility rating for the firm. If we have a look, we can see that Deluxe has a lot of capabilities to issue debt and how it impacts its ability to pay back interest. Deluxe has always been able to pay back its interest with strong EBIT interest coverage ratios, which means they are able to increase their current levels of debt based on their current EBIT expectations. As we can see on the chart above, we made an analysis on Deluxe's capacity to pay back the same interest based on how much debt they issue on each different bond rating. Since we are only considering debt that's above BBB in this instance, we made two analyses, one for a normalized 5-year EBIT and the other for a downside EBIT. So if we look, even in a downside year, the firm is able to issue attractive BBB or higher rated debt. And it has a financial position that is strong enough to withstand an increase in interest that needs to be paid without reducing their interest rate coverage by all that much. The firm is able to issue more investment-grade credit debt than all other types of debt, and it has a lower interest rate coverage requirement as well. The firm overall has a lot of flexibility from a debt issuance standpoint. Now, if we have a look at the capital cost by rating category, we're going to dwell a little bit deeper into the firm. So if we look at their equity structure, we made several analyses to find estimates of equity and debt costs within the firm. As we can see, obviously, issuing equity is a lot more expensive than issuing debt. So for this reason, we want to increase the amount of debt in the debt to equity mix and avoid the higher cost of issuing additional equity. The way that we would analyze the situation is that the higher the rating of debt, the higher the cost of it. But the ratings provided only give us the risk of default and loss that can happen if the firm goes bankrupt. So it doesn't really guarantee the lowest cost of capital. So when we calculate the weighted average cost of capital, we find the lowest rate of return that Deluxe must earn in order to stay in break-even position while issuing different tranches of debt. The company would want to issue debt that provides a higher rate of return than its weighted average cost of capital. So the first analysis, we used Hudson Bancorp's estimates of equity cost, and there is little difference between the after-tax cost of debt of issuing AAA and BBB rated debt. However, issuing BBB rated debt obviously implies a much higher coverage ratio. But we don't really mind that since Deluxe has been able to pay back the interest on its debt with healthy interest rate coverage ratios. So we believe that issuing BBB rated debt instead of AAA would not impact their ability to pay back interest as much as people would think. Based on this analysis, we also find that the cheapest debt to issue is BBB at an 8.24 weighted average cost of capital, which is the minimum return we would expect for the type of debt. We also did the same analysis using CAPM and a levered beta and came up with the same conclusion. Triple B rated debt is the cheapest at 8.64 weighted average cost of capital. So it would seem like an attractive option for Deluxe to issue this type of debt that could be cheapest, even if our credit rating is affected. But we still are above investment grade. So investors should be happy while we provide some attractive coupons to our bond holders. Equity investors already said as well that any debt being issued has to be higher than investment grade. So it shouldn't be concerned if we actually try to issue some of this type of debt. And an increase in interest payments also serves the firm as a tax shield in the future. It could increase the overall value of the firm. The alternative to issuing debt generally would be issuing equity, which could dilute their earnings and their current position. So that's something that they would be looking to avoid as well. Now, if we have a look at the next slide, we look at the current debt level. So if we look, we can analyze the current financial situation of Deluxe. It has 161 million in total debt. 11.5 of this is long-term and 150 is outstanding commercial paper with an interest expense of about $2.8 million. Deluxe also currently has an unused line of credit, and it's projected that it would have about 124 million in cash on the balance sheet next year to support short-term debt. So current debt levels are low and manageable, and Deluxe has had a strong EBIT coverage ratio over the past decade, proving that the company can pay off the interest on its debt, and it has enough free cash flow that it could divest towards paying this debt or looking at different types of investments. With the current level of debt that Deluxe has, it's minimizing the cost of financial distress. However, the firm is not maximizing shareholder value by exploiting the interest tax shield. Increasing debt to a certain degree will actually decrease the cost of capital because interest on debt is tax deductible. So they have not maximized its potential in exploiting this debt as a tax shield. Our earlier analysis showed that the firm can increase its debt without losing the investment grade rating on its bonds. They have a maximum unused debt capacity of 1,294 million at triple B rated debt. If we issue the max amount of debt, we can also reach a DE ratio of 0.35. So it will take some time, but the firm is definitely in a great financial situation to be able to do this in the coming years. So now let me turn it over to Kwaku to provide specific recommendations for the mix of debt and equity.
Thank you, Rafael. So as Rafael did state earlier, we're going to issue a triple B investment grade debt instrument to give Deluxe Corporation the flexibility in its capital structure. Our base case scenario will be 1.4 billion approximately, and our worst case scenario will be around 810 billion, which will give us the tolerance, to play with the debt to equity ratio of 0.55. Next slide, please, Nancy. So based on our evaluation and analysis, we suggest that Deluxe Corporation stock price is overvalued, warranting a cessation of share repurchase program. The firm should remain mindful of potential changes in interest rates and tax policies that could impact the financial outlook. By diversifying its business ventures and focusing on more promising opportunities, Deluxe Corporation can enhance its prospects for long-term success to generate value for its stakeholders. One of our critical assumptions in our valuation analysis today is a growth rate of 2.5%. However, considering the checkpointing industry limited potential for growth, failing to achieve this growth rate will result in a lower firm value and further overvaluation of its stock price. It is important to note that our analysis assumes a stable interest rate and tax rate. Any further changes in these factors, such as inflation or alternate policies in tax acts passed by Congress, could significantly impact the results of our analysis. Therefore, the firm must remain vigilant and adapt its strategies accordingly in response to the changing economic conditions, rather than focusing solely on business segments that may become obsolete in the future. We recommend Deluxe Corporation allocate some of its debt towards exploring alternative avenues of business that align with its current business strategy model and have the potential for higher profitability. This diversification strategy will favorably be viewed by shareholders and stakeholders and position the company in light for future growth and sustainability. Thank you for your time. And if you have any questions, we're ready to address them. Thank you.